of the outcome, right? This is like 2018 all over again. And why I say that is this dude still has everybody's attention. Can we agree on that? He got everybody. I mean, I know it's all indictments, but just like when he was like just that reality TV Trump skyscraper owner, had nobody attention at first till he come down them escalators and call all the Mexicans rapists. Like he has captivated everybody's attention. I mean, and this is the part I don't like because people are watching that the haters, the fans, like he has gotten everybody's attention because everyone, debates are going on. They're waiting for him to show up to one of these debates, but I doubt if he's going to come until it's time. Like if he shows up, that means his attention has dropped, and I'm sure he's watching ratings. I'm sure he sees all these numbers. Attention has dropped. And what I realize is just it's a lot of attention, and the court case is gonna go on regardless, but he's winning the attention war. Out of all of the candidates,
Last
he's still got
last
more attention.
statement.
Go ahead. Go
My
ahead.
last statement before you pass it on to Brother Earl is that in 2016,
Okay.
when he was running, it
Yes,
was
sir.
more grandstanding for positive purposes on his part. I'm gonna be the
Yeah.
president.
No.
I'm gonna do this and I'm gonna do that.
Yeah.
This
Yeah. Yeah. Yeah.
this portion of it, what you call the attention,
Yes, sir.
I don't.
What's
He's
up, Joe?
not really controlling. He's not controlling the attention like he was
Not
back
as
then.
much. I give you that.
Yeah,
Right.
yeah.
Not as
It's
much as he
it's
did back then.
it's a whole different type of attention that he
I
gets
got you.
compared to 2016. This
I
that
got you.
attention that won't let him have a jury. Now, if he get a jury, and it's
Yeah.
not a judge, but a jury,
Oh gosh. Right. Right.
he he, he counts Christmas.
He gets a Christmas.
Yeah, he counts Christmas. Yeah, he counts Christmas. Hey, the way he ain't talking about nothing about the country, and everything he said about the country is
Yeah.
a lie. You know what I'm saying? So, oh,
I
I can
think
get this border situation done day one. Like you was the president for 4 years. You still ain't never get it done.
he said they stopped
You
me. They
know what I'm
stopped me.
saying?
It's some other folks. They stopped me.
Yeah. So, but I ain't gonna belabor the point. My bad. Go ahead.
No,
That
you're
ain't
fine.
what you want to talk
You
about.
good? No, you good. We started out. I just wanted to kind of say that because there's some other folks that have been creeping up with their making statements and old stuff popping up, and now they got attention. I feel like they got an album coming out, so we'll see. All right, so Earl, good morning, sir. Thank you for rocking with us on this Financial Tuesday. My topic today was about the IRS concerns, fears, and realities. If you listen, well, I at least say in Atlanta, and I'm sure probably all over the country now. If you listen to any portion of the radio, it seems like two things dominate. One are the lawyers. You get in a wreck, you get a check. The lawyers talking about if you get into any accident, we'll get you paid. We'll get you paid. Jay Sanders seems to be the one that dominates here. I don't know who's your your lawyer in the DC, Maryland area that dominates on the radio. But we also the second highest advertisement are talking about companies that will help you with the IRS distress. Get you out of your mess with the IRS. um, so I want to let's give some clarity to it. There's always there's an urgency, but sometimes I feel like there's I guess a fear mongering. I've heard that word so much, just to place fear to kind of get you to move fast or to to hire companies that you may not need. Like you might have some stuff that's you could just simply do on your own. And then of course there are moments that you need professional help. So I
Right.
got you on because as we come to the close of the year, just to bring some clarity.
Sure.
So
Yeah. So what I tell people directly from the IRS website, if you owe the IRS less than $10,000, you can pretty much go into their website and you can make a payment arrangement. You can pay it off in full, and if you need to schedule a payment arrangement, you can do it up to 72 months, which is 6 years. And that doesn't necessarily have to be for 10,000. I think it's really under 50,000, where you can be able to set those payments up and you pay it over 72 months. When you come across different organizations that you see on TV, or you may see them, you may see advertisements on Facebook or Instagram for companies who are where they can go before the IRS for you. Though some of them are legitimate companies who can represent you before the IRS and to help negotiate a lower payment amount or to completely get rid of the tax debt overall. Now you're going to pay a fee for that. It's going to be generally it's going to be a whatever rate that the people charge. It can go anywhere from $2,500 to $10,000 plus. That's going to depend on how much you owe. It can be a factor of all of the work that has to take place in order for them to represent you before the IRS. You'll find many people who fall into this category. Many of them can be business owners where they have not put anything, they didn't set anything aside for the IRS. If they had staff or employees, they never pay payroll taxes. And so that's how that number can really go, can skyrocket real quick. And that's why you're looking for that type of assistance. So what I would say to people is, number one, if you are a business owner, number one, and you have employees, pay the payroll taxes and pay them like when your people get paid. In most payroll systems allow you to be able to take care of that, and then set aside your quarterly taxes based upon whatever your profitability is within your business. Remember, if your business does not have a profit, you do not pay taxes. And that's one of the advantages that, when you are having multiple streams of income with having losses, that you can be able to offset the losses for another source of income.
Okay. And just a quick shout out. What's up, Brian McCory in the building. Lisa, good morning. Jeff, good morning. Happy birthday, Mama McCory. Good morning. Good morning. Happy birthday. Happy birthday. Make sure you give her flowers and shout out. Jeff had a question. He said, I pay quarterlies. If I paid less than my accountant set up for me, will the IRS be on my tush?
The question is that no, if you pay less than quarterly, well, it depends on how much you pay. Whatever your estimated quarterly tax. Well, let me rewind back. So I can tell you what estimated quarterly tax payments are for those who are in the room. So for estimated quarterly tax payments is an estimated amount of taxes based upon how much someone will profit or make within their business. Based on whatever that number is, you use to back in to determine how much taxes will they owe. Generally, whatever their accountant or tax advisor will prepare some type of tax plan for them and let them know, this is, in order for you to not owe, this is how much you need to set aside on a quarterly basis. and so you make those payments every April, June, September, and January.
So
So,
so when okay, so would that be just for like businesses, or is it because I have a lot of amount coming in, certain amount of money, coming in, or
so it
I
can
need to
be
keep up.
for
Go ahead.
sure. So it can be for individuals as well as businesses as well as individuals. So
Okay.
for individuals or people who your you file a Schedule C, it all goes on it's all on your personal tax return. So
Okay.
you'll make those payments during those 4 time periods in which we discussed.
Right.
But it can be for high income earners. So
Okay.
for people who are making, 150, 200,000 plus, it can
Right.
be for people who itemize, where they
Okay.
have decided to because you're able to itemize on your tax return, meaning that you use your real estate taxes, your state withholdings, charitable contributions, uh,
Gotcha.
and mortgage interest, you're able to reduce your taxable income that way. So for some people, they decide, because they itemize, they reduce the amount of federal withholdings that they have from their paychecks. That works for
Okay.
some. That works for some people, but not all,
Okay.
because
So
because you can still pay a lot of money in taxes and itemize and still owe.
okay.
It
In other
really
words, you
does.
still
So
feel violated.
You still feel violated.
right.
So
Um,
it really is really looking at the individual. Do you really want to break even at the end of the year? Do you want a refund, or do you want to have your cake on the front end and pay them later? Some
okay.
people decide, make that decision, and they have to live with it. It's just that what is the best scenario for you? So for Jeff's
Mm,
question, if he paid less than what the accountant said,
right.
did the accountant set it up so that he would break even, that he would get a refund, or
Right.
what that number is? So it really
It's
depends.
it's just easier to kind of keep up with it doing it that way. You're saying.
Yeah. So because I
Okay.
would
Not easier.
like,
It's not necessarily easier
Okay. It
because it's more
it's
detail. I mean, it's where do you want your details? You want it throughout the year? Do you want it at the end of the year?
right. That's what I mean. And that's what I mean. Like it's how like you trying to keep track of stuff, and it's like you have a pile of papers. So we're gonna wait till it gets this high, or
Yeah, it's over
we're
there.
gonna manage. We're gonna right. What I'm saying, we're gonna manage it like every step. Like, okay, let me staple this together. Let me put this together. Is that so? Is that what the quarterlies are in a sense? No, or did I just miss it?
No, are you
Okay.
talking about? So you're talking about itemization of taxes when you're a high earner, or are you talking? Are you still talking on the business side?
Quarterlies. I was talking
Oh,
quarterly.
quarterly.
Like,
Oh, based
yeah,
on Jeff's
yeah,
question.
yeah. So
yes,
I'm
that's
saying
what I'm
with
talking
his
about.
questions, he said that if he wanted to pay less than what his accountant recommended, would the IRS be on his tush? I don't know what those amounts would be, because
Right.
that could be a little bit or that could be a lot.
Yes, you
Yeah,
will be
could be a little bit.
penalized.
Yeah.
It could be a lot. Right.
But the thing is, but
So,
either way, is it fair? You're going to be penalized if you don't pay, because it's always going to be interest and penalties on what's not paid, or is the penalty applied to the tax year after you filed?
So let's give an example. If, let's say, you file and you have paid, if if you have paid 90% of, let's say, if you paid 90% in, and whatever amount is only represent like 10%, you're not penalized as long as you
right.
pay the balance before
Yeah.
April 15th.
Yeah.
Or if you
Okay.
have if it is 110%, then what the previous year was, then you're not penalized as long as you file on time by April 15th.
Yeah.
It's when you
Okay.
start going beyond the tax deadlines, and
Okay.
you can really start getting into the fines and penalties that way.
Right.
Okay.
Remember, because if you're in that year and you make that deal or the quarterly payments, the interest and penalties are only going to be based on past tense after
Okay.
the deadline. But if you're talking about paying something, towards your projected tax throughout the year, there's no penalties because it's pre.
It's prepaid.
Right. Okay. All right. So, okay, I got a question then. I got a lot of questions. So,
Go.
if when like for in your professional opinion, is representation needed if you're like W-2 and one side hustle? I couldn't think of the proper W-9, W-10, the independent contractor, would you need representation like for things like that, or do you feel like any IRS dealings you should have some level of professional representation? Do you think?
Sure. So
Your opinion.
So it's going to also look at it. It depends. So if it depends on how much you made, did you do the right thing along the way? So like, if you were a W-2 employee and you had the right amount of taxes set aside when you got paid,
I'm saying yes,
then you're fine. And your side hustle, your business is going to help you. You can be able to take care of the taxes that way. Basically, you can be able to use the earnings either from the W-2 or the business to be able to take care of that tax that if you owe it. Just depends on whatever it is. Now you have some people where years ago, before they changed how withholdings were done, some people would do like claim non-exemptions or non-dependents during the course of the year.
Right, to raise up.
And so I've been that person at one point in my life as well. So, you wanted your money at the front of the year, and then I can deal with it later on. Now, you have to make sure that at that time, when later on comes, that your financial situation is the same than it was when you started. Because
no, sir. No, ma'am. No, ma'am. No, sir. I'll be all right.
Their situation changed. People their situation changed, or you adjusted to the lifestyle of what that take home pay would be. And so you'll find yourself, I didn't, I know I owe, so I'm not going to file this year. I know I owe again, I'm not going to file the next year. And then here I go later, 3 or 4 years later. I'm talking about myself here.
All right. Okay.
Before I became a financial professional, I was that guy.
Okay.
So
I got you.
Not only am I the president of the hair club,
I can speak from experience.
Also a client.
Hey, transparency.
Okay.
Transparency.
Love it. I love it.
So you end up finding yourself in this situation like, all right, at some point I gotta get this thing right, and you end up having to sit with this bill, and so so you work through it. So to get back what you're saying, it really depends on how much income you have. Did you do things right on the front end? Or were you trying to work the magic tricks? And there's nothing wrong with magic tricks. It's just that you gotta you gotta pull
the rabbit out. You gotta make sure the rabbit comes out
to resolve that tax matter.
Okay.
I was that dude too, man.
Okay.
Try to get. I'm like, I was on some Wesley Snipes. I didn't want to have to pay it all.
Not the Wesley
I'm
Snipes.
like, you're gonna give me my money. I want my money throughout the year, and I'll deal with the end
So-
of the year when it comes. And then the end of the year comes, and it's like Beetlejuice.
So
Big
let
on
me
payment
ask you
plan.
guys. Let me ask you guys this then, because you guys being transparent. Did you fix your own mistake? Like, I gotta get this right, or did the IRS say, "Hey, buddy, we ain't seen you in some years"?
Well,
So I filed. I just didn't. I just owed.
Okay, you filed. Okay, you filed and owed. Okay, you were the
so
one
Yeah.
that
eventually, so
I
after
want my
4
money
years,
now.
yeah. So after 4 years, I decided I needed to get it right because I
Okay. You
think
did
I
it
had
your own.
started to go. I had to go back to school or something like that, and
Okay.
with school, they need tax returns and things like that. So
Right.
life will find its way to come back around for you to
Right.
get your life back in order. And so
Gotcha.
that's what I did. I think I ended up going back to school to deal with it. And I was able to, use, and I think I had just started the business. And of course, when you're starting some businesses, you're taking losses. Then I had
Right.
education credits. And so some of that
You need your
help to
credits.
pay down the tax bill.
I got you. Okay.
And so now I'm finished with a master's degree.
Yes.
What else we got going on now?
Congratulations.
Right.
Yeah,
Congratulations.
thank
Yes,
you.
sir.
I unless one of these colleges is paying for a doctorate, I don't think I think this
I
is
think you're
it.
done. Just gonna hang it up.
I'm
Like, you know what?
done.
I'm good. I'm
Nah,
good.
So
Yeah,
Dr.
because school is a whole
Dr.
nother
Murray.
tax. That's a whole nother debt.
that
Dr.
is
Murray.
a whole,
Dr. Murray.
that's a whole nother debt. And
That's
y'all
right,
still
Dr.
ain't
Murray.
talking about that
Dr.
daycare.
Murray.
Y'all still ain't talking about the daycare that's about the cost of a
Oh,
mortgage. So
Oh,
let me-
yeah.
it's going to be a little while.
You know that
Before I
dream
go
car?
back.
You know the dream car that dream car you wanted?
Yeah, they're about the same price.
This name them your dream car, you know.
Right.
Larissa was the Benz. Little Larry was the Beamer. I was like, look at my Benz and Beamer.
So,
nice.
so yeah. Yeah. You just got to work through it.
Okay.
But for some people,
Awesome,
they
awesome.
do need to go see professional
Right.
professional people because the
Same,
amount.
right. No joke.
But-
Right.
but-
It's 2 kids
but-
at the same time.
You know, so before when I early on, I let them take I just let them take everything out my check. I was like, whatever, and I didn't bother to file. Right, I just never filed. I was like, they owe me the money. They owe me the money.
They owe me money.
Well, I'm not going to file. They're going to find a way not to give it back to me anyway. So I'm not going to file.
Wow.
Then I meet
Wow.
Mrs. Banks, future CPA at the time, right? And she was like,
Okay.
She's like, dude,
What did you do? What are you doing with your life?
Right?
Right.
So we was dating at the time, and here it go. She filed my taxes, but guess what?
What's that?
I still ain't see the money.
Because you waited too long.
Oh no, she
took it.
She took it.
Oh, good.
that was her fee. That was her fee.
But she didn't never file those years prior to me meeting her. So what I'm saying is, like the IRS, how they can come back at us. Can I come back at them for
No
1993?
No sir.
92?
No sir.
Well,
No sir. No
Yeah,
sir.
they won't. But
No,
it's
sir.
not a statute
No,
for
sir.
them, though, right?
No, sir.
They don't have a statute. They can come get me 20 years later, right?
Right.
No, there's a statute for that too.
Okay.
Yeah. So the furthest you
Let's
can
go back.
file, and you can only go back 3 years to claim a refund.
Yeah.
Gotcha.
3. So
And what
Let
about
that marinate, guys.
So 20, 21, and 22 is the only ones you can get a refund off of now.
All right.
Anything prior to that is done.
Gone.
But they don't play by those rules.
But what's
Right.
what's this
Now for them, they can't collect the tax. I think it's 10 years from a tax owed from 10 years from when it was filed.
Right.
Wow.
So let's say if you filed, if you had a tax debt from 2013, that's about to roll off at the end of the year.
All right.
They come at you like bankruptcy.
Wait. But hear what he said: 10 years from filing, right?
Yeah.
So
what if you didn't file?
Not filed. Is there a statute?
Yeah.
Is there a statute on not filing?
No, because they can come. Because they can come back.
My $1 million contract got in 1995.
And life will.
They coming for that money.
Because there's people who have to file, 5, 10, 15 years of taxes.
Right.
Because they just didn't. And
just didn't.
And that clock starts. So if you didn't file from 2004 and you're doing it from now, then that clock is going to start from 2023.
Oh, wow.
Baloney.
And so for those people, that's why they go and get the tax professionals to try to reduce that to reduce that debt.
Right.
So they be coming up with all sorts of stuff. Oh, these shoes I use for walking in this marathon. So whatever I pay for these shoes. Oh, I donated some clothes to
there you go.
The Salvation Army. That year was like my Versace, my Fenty, all that
Versace.
Stuff. I donated that to charity.
Right. And so the IRS looks at it like, hey, if you haven't filed your taxes, what's the odds of you really having the documentation to support that stuff from 20 years ago? Now, some people, they may just have it, but most people don't.
But what's the odds that they got documentation too? They got their own documentation.
right. They got it.
They can't handle the truth.
They don't need to. They make the rules. They make the rules. He said Larry up in his Versace on the floor. Right.
My birthday.
Oh man. Kaneem.
Yes, sir.
I just make sure you're still there. You with us? You got it.
Oh,
you got hustles and
man,
businesses.
I don't know nothing about no taxes, man. I'm listening and absorbing information.
So today we're talking about IRS concerns, fears, and realities.
So we got another question.
Go ahead.
Jeff who said,
yes. Oh yeah, this one. My bad.
So they filed married filing jointly. Is Kim's W-2 income taxed solely on the income that she's taxed on? Or is she taxed because of your income? So she's taxed based on her income, based upon what that is. However, it depends on when she filed the W-4, because that changed to 2020. On the new form, it says, are you married, filing jointly? And so, does your spouse make similar or more money than you? And so they know whether to tax which person a little bit more, to tax you more, because you have a person in the household that makes similar income.
You're talking about the W-4, but not the W-2.
Correct.
The W-2. See, again, I'm married to a tax professional too. And I ask her a million questions like, what you doing? Right. So, but when you file jointly at that point, it's just a combination of whatever you guys owe at that point.
Combination of you both.
And whatever line items and all that other stuff and more stuff. And then it says, this is your number. Mm-hmm. Right? So
when you're married filing jointly, in most people's cases, it is more tax advantages for you guys to file jointly than separate.
Okay.
And so
Right.
you get some of the benefits of a married filing jointly, taxes like different tax credits that you're able to get, that you get as together rather than separately. And so, and then the tax bracket ranges are different from together to together jointly versus separately.
All right, so Jeff, what we're going to do is, Carolyn and you will file together, and then me and Kim will file together. So we'll take advantage of the lower, and then you and Carolyn can take the higher income. How about we'll work this out? We'll work this out.
That's right.
So, so there are some times where you want to file separately, and that's okay. Like sometimes if you work for certain agencies where you have to submit tax returns, and you don't want the exposure of your spouse's business activity, then you may want to file separately. If you guys don't have assets together, then you may want to file. You may be able to file separately.
Yeah, there's a term. What's the term called? Injured spouse or something like that?
Spouse.
Yeah.
Yeah. So injured spouse is where when one spouse owes taxes, but the other spouse was not aware of what that situation was, and so they're able to file the injured spouse with the tax return, so that the spouse, whatever their refund would be, they're able to get that portion, but the other spouse still owes. And then sometimes with the IRS, they may say, well, you benefited from this person with their situation. You still, if something happens, then you still got to take on this debt.
Yep.
Right.
So, for example, I had a client whose spouse passed away. The spouse was the one who was taking care of all the finances, and abruptly he passed away, and she didn't know that they had this huge tax debt. She's still responsible for the debt because of how the taxes were, and they filed together. She benefited from the lack of him not paying the taxes on time, or how they lived.
Right.
So it really depends. And so, some of these are just conversations that, especially as married couples, that you have to have those conversations in terms of, you have to have a conversation about finances overall, but what does your tax situation look like? How can, if you make this move, how does this affect us as a joint unit?
Gotcha.
Right. That makes sense.
All right.
All right. I'm good. I've got my questions out. Anybody else had any other questions? Kaneem, I put you on mute because you got a lot of background with the car. But if you had some questions, I'm gonna put you off. Because
I know why you put me on mute. I know why you put me on mute.
well, that too.
But also, I think Carolyn was talking about did it get rid of the form had changed now, where you can't itemize? Is that something?
In terms of your
W2, your W2,
yeah. So you can't do dependents on the federal form like before.
So just the dependents, because she said something about something changed where. So just the dependents, it wasn't like itemizing other things. You still.
So in terms of itemizing, that's on the actual tax return itself. Now there's a limit in terms of how much you can claim as an itemized deduction in terms of state and local taxes and real estate taxes. They capped it off at like $10,000 in terms of how much you can claim. So people who live in the Northeast, like us, New Jersey, New York, Maryland, California, Connecticut, if you have high real estate taxes, then the most you can claim is $10,000, and that's in addition to what you claim is your withholdings. Your mortgage interest is still the same. Your charitable contributions are still the same, but that's a cap. So just imagine, in 1 year, if your state withholdings in one, prior to then, let's say, was about $25,000 on just the taxes alone between you and your spouse, you can only claim 10. That means that's $15,000 worth of income that used to be reduced, but is now considered as taxable. That was when Trump was in office with the Tax Cuts and Jobs Act, but that's getting ready to expire.
Yeah,
And so we have to look and see will that remain in place, if Congress will keep that act in place, or if it will just phase out and go back to what it originally was prior to then.
Did he do that to help himself out?
Hey, if it helps everybody.
I mean, All right.
All right then.
And one other thing is that you don't have to fear the IRS.
There you go. Let's get to that.
Why not?
Yeah.
You say those 3 letters? I'm shook.
So for some people, so one thing, if you have advisors or people who are that is on your side, allow them, because they're the ones who got those are the ones who have the expert. They're the experts, so they have knowledge about what are different things that the IRS is looking for. That's number one. Number two, the IRS code is so huge. The people who work for the IRS don't really know the IRS code. And so and so you have to it's so huge. And so if you have a tax professional who they understand, whether if you have a business, you have a real estate, you have investments, they can be able to best advise you in terms of how to best properly structure your business, or when to take losses or not, or when to make purchases or not, when to make sales or not.
Right.
They can be able to best help you with tax planning. And they can help you out. That takes place during the course of the year. But not having a tax advisor or someone to help you out can really cost you. Had a gentleman sold a property the last week of December, made almost a $200,000 profit, no tax planning, and that was a huge bill for him. Because sometimes entrepreneurs, you kind of want to skimp on certain things, and this is not a you can't skimp on wise counsel. You can't skip on tax, financial advisors, accountants, those type of people. Yes, you're going to pay, but do you want to pay? You want to pay that price, or do you want to pay that price to the IRS? And unfortunately, that person, they was in that scenario. And so it's just really about what is your scenario right now and how you can navigate through it, because there's things that can work in your favor, but you got to plan for it. Now, if he would have came and said, in October, this is what I plan to do, then he would have gotten the best strategies on how, when the house is sold, what he can do to be able to reduce that tax debt. But if you don't, that's not on me. That's on you. Go.
So that begs the question, because you used the example of December and a real estate transaction and essentially $200,000 in capital gains based on his profit. Right. unless you have a legitimate offset through another business venture or something like that, that just there's no upside to a $200,000 capital gain, because whatever you owe for that gain, you owe. There's no decreasing the
Correct.
taxes on $200,000, but there's offsets.
Correct.
Yeah. Okay. All right.
Yep.
What are those taxes you paying when you're doing the deal? That doesn't count.
No, because you're talking about what you walk away with.
Transfer tax.
Yeah, that's what they walked up. This was dealing with after.
Yeah.
That's not fair.
No, nobody said it's fair.
Not fair. Not fair.
It's
Not fair at all.
There's nothing
Not
fair about our tax code.
Nope.
You're paying taxes here. At the table, you're paying taxes. Right, this guy a check. This guy a check. This guy a check.
And somebody keep on muting me. Why they keep muting me, I have no idea.
I hear you. You right here, brother. You ready to disturb? You got a lot of noise happening, sir. You got a lot of noise happening, and you're making a lot of noise.
You put it in escrow,
But,
Jeff. That's what you do. You put it in a separate account, and you hold on to it.
Can I ask my question now?
Yeah, go ahead, brother. Go ahead and ask your question.
So that $200,000, if he would have had some type of not a 1031 exchange, but if he would have had another vehicle, how many days before that capital gains is actually taxed on that 200,000? Does he have 30 days? Does he have 90 days? Is it 180 days, or is it immediate upon purchase or disposition?
Yep.
The day is done. Is the day you owe. You just don't know how much.
So is it best to just keep those funds and try to defer the payment for as long as possible and put it into
So if
a different? Go ahead.
So if I was him, I mean, unfortunately, we're talking about real estate, so probably someone was trying to move in. I would have seen if he could be able to move the sale of the property to January. That way, you got 12 months to deal with tax planning during the course of that time, rather than 7 days.
Yeah. Because no matter how you look at it, that money is going to be owed. And the question is, do you give yourself a whole year? My thing is, the mistake was doing it, closing the transaction in December with that much capital gain. You gave yourself no opportunity to plan for it. If you do it in January, you got the whole year to try to figure out how to pay that capital gains tax.
He probably thought he was doing himself a favor.
Yeah, it was end of the year bonus.
Out of it, because you don't got to pay taxes. You don't have to pay taxes on the property the next year, right? So that's probably what he was thinking. So he still got to pay property tax too, right? For that year.
Well, no, the property sold. So whenever that took place, however, when they transferred the title, all that stuff was at or before the closing table, whether with dealing with the property taxes, because he may have, depending on how long he had it, he may have gotten a credit, or it would have been transferred to the next person on who owes it.
So then
because remember, typically your property taxes have already been paid by December.
Gotcha.
Or something. Well, it's prorated when you get to the closing table, but
So with Kani's example, he used the money and bought a car within those 7 days. So he gets taxed on the money, on the 200, and then when he buys the car with that same money, he gets taxed again.
Well, my question was, how can you defer that payment? That's what I'm saying.
Right.
Because I know that if you get a in kind or like kind investment with the money, that's one way to do it. It's still owed, but it's deferred. So
yeah.
Is there another option?
He has to defer the sale.
So what if he don't pay?
So what? Well, maybe my definition, because I could be wrong, because I am not a tax professional. But
Sure.
what is the purpose of a 1031 exchange?
See that?
So it
We're
is to
getting deep.
defer.
Get deep,
So,
guys.
sure. So the purpose of the 1031 exchange is so that number one, you avoid the capital gains at the time of that sale. It's deferred. So
Yeah.
let's say if I had $100,000 profit off of one property, but I'm taking that money to go purchase another property, then I can be able to take that money, put it into another property, which is probably going to be equal or more value. Then when I sell that property, then I'm dealing with it then. All I'm just doing is to delay the taxes based upon the sale, because you may deal with low cash flow based upon whatever your situation is. So I can roll the profits from one house into another, and I don't have to worry about it at that time.
So
yeah. So go ahead, Brian.
But
Kaneem, no, I'm just thinking about what you said, because you're talking about a deferment of the tax,
Of the capital gains tax. That's what
capital gains tax.
But I was wondering, is there? I knew about that, and he explained it just what I thought the definition was. But is there another option besides the 1031 exchange,
right,
where I can defer my capital gains tax? That's what I want.
And you correct me, and I'm not getting ready to try to take the position here. I was trying to get some clarity on when the transaction is done, even though the capital gains tax is applied, then it's still due when you file the following year. It's not like if I make the transaction on December 15th, I owe capital gains tax. No, it's just knowing that the capital gains tax is coming due when I file the following year, when I file my taxes. That's a deferment in and of itself, but you can push that further out with the form.
Well, that's not. I think we talk about two different things, maybe. But I'll let Earl. Is that? Did you understand how he explained it, Earl?
Yeah. So what he
all right.
He's using the same way in which what we were talking. So using the December example, if it's sold in December, you still have until April to file. It's just that for tax planning purposes, there isn't nothing outside of this capital gain. You don't give yourself enough time outside of this capital gain sale to do another activity to reduce this amount because of the time window, because it's still the year still ends December 31st. You still got till April 15th to file and pay the money without a penalty. That still stands. What we're saying is if it was waited until he sold in January, then you have January to December to do the planning for that capital gains, and then you have from that January to next April to get the money to pay on that capital gains. That's one part. I think your question is, what is some other way to be able to offset that capital gains at a given time period? Because that's it. Go ahead.
No, I was just saying. Well, my question is, just run with me right quick. So, I got a $500,000 house, and I got $300,000 in equity. I decided I'm gonna sell it, but instead of me selling it outright, I got a commercial property that they want for $1 million, and it's only gonna cost me $200,000 with 20% down to get it right. So I'm gonna put my whole $300,000 equity in this new property with a 1031 exchange. So I went from a $500,000 house to $1 million building with a profit.
Go ahead. I was trying to let you go ahead, finish your thought, and then because I need some definition. But go ahead, because I'm trying to.
My $300,000 in equity, I'm using that as a down payment on this $1 million building, right? But I'm using a 1031 exchange, so I haven't gotten capital gain because I got a property that's more valuable than the one that I had.
Nope.
Do you understand?
Okay, wait. We're
I,
taking it slow. Take it slow. Because what's a 1031 exchange? And I'm not asking you specifically necessarily Kadeem, but Earl, break it down. Just make
Sure.
layman's term. Let's 1031 exchange.
Sure. So a 1031 exchange allows for so when you traditionally when you sell a home, you
Right.
pay the profits on the sale of that property.
Okay.
And that depends on how much you purchased it for. Did you put
Right.
any renovations into it? Did you add anything into it during the course of when you possessed it?
Right.
Then we look at whatever the difference is, whatever that amount is, that's what you pay the profits on. The amount
Right.
you receive at the settlement table can be different from the profits you receive. Can the amount of profits that you receive from the overall sale. Those are different numbers.
Okay.
Right.
So now, so let's say if I bought a $500,000 house, cost me $300,000 to purchase it, and I put $100,000 of renovations in there, then that means the total cost was 400. My profit is now $100,000, and I need to pay the capital gains tax on that 100.
100. Got you. I'm with you on. All right.
Now, from there, what the 1031 exchange says that, hey, I can take this $100,000, put it to the side because I never received it. You paid the profit on, when you have sold a property, sold an asset.
Right.
I can now, with the 1031, I never received the money. It is now passed through to another channel to allow me to purchase another property.
So in theory, like it's not taxed. It may not be taxed as a profit because it's just you just transfer it.
I've used
it.
I've used it as a down payment for the next property.
Right. I'm with you. I'm just clarity. Let's get some clarity. All right.
It's not taxed yet.
Okay.
Well, go ahead, Earl.
Yeah. So
go ahead, answer Kaneem's question.
So I've now moved this money into a 1031 exchange.
Okay.
And now I have to and now I put the money into this new property. Now, if I keep on, many people when they're in the real estate space,
tell it, Earl. Tell it, Earl.
They will continue to do this over and over and over.
Tell it.
Reduce, and they will never pay those taxes.
Tell it.
Because they have moved it from one property or one function to the next.
I got you.
And that's completely legal.
Tell it.
But it ain't, you're not exempt.
Huh? But they're not exempt.
No. Okay. The taxes are still allowed. They just deferred. But if you ever sell it though, without exchange.
Okay.
Right. Now,
that's a whole different ballgame.
Now here's another thing. You can sell your home as long as you lived in that property for 2 out of the last 5 years. You can sell it up to, if you're single, you can sell up to get a gain up to $250,000, and you don't pay any taxes on that. If you're married filing jointly, you have up to $500,000 that you are exempt from the capital gains. When you sell a personal property,
primary home, okay,
for your primary home. So this is a way that people are able to, when you use the equity, as long as when it is a personal property, that you can be able to gain wealth. That's why people say it's gaining wealth through real estate is very profitable, because you're able to get those exempt from capital gains tax.
Gotcha. So hey, 5 years.
I got to get ready to jump, but you gentlemen enjoy the day. And Earl, I'm talking about Earl, my man. Hey, I'll talk to y'all later, man. Y'all enjoy the day.
Take care, man. Be safe.
Later.
So those are the things that that works to your advantage. It's about knowing it's about getting into the space where you can get with the investment of real
There we go.
estate.
Okay. Okay.
So yeah.
Awesome. Appreciate that. That's some knowledge. Took us a while to get there. I appreciate you sharing that. Hopefully it gives you a little more clarity on the IRS and concerns. He said, can that exempt be used more than one time, Earl? Personal.
If you live in another home for another 2 out of the last 5 years, you can be able to use that over and over and over. But you need to just be able to occupy that home within that time.
You got it. At least you said at least 2 years you got to occupy the home.
Two out of the 5 or something like that. And I don't think they don't have to be consecutive years either.
Okay. Interesting. Okay.
I didn't know that.
Look at that. And knowing is half the battle. All right. So we appreciate you guys for being here. Another edition of the Brothers of Legacy.
Hey, we're selling the house.
Has it been 3 years? How long has it been? 4 years?
Or
seems like, wow. Time is flying. All right.
Yeah.
Oh, we appreciate you guys for being here. They got one more year. One more year. Appreciate you guys for being here. Jeff said, think that was great, Earl. Thank you, Earl, for being here, giving us some clarity. So don't be afraid. Just take care of your business.
Don't be afraid.
You know what you got to pay. Just give them a call. Say, hey, I need to pay you. Take care of it. Get a professional. Just to get clarity and figure out the next steps, and what you need to do. Call Earl. Get with my man Earl, E.T. Murray III. Make sure you follow him, connect with him, and use him as, help him with your tax situation. All right. So we look forward to seeing you guys tomorrow, Mental Health Wednesday. Again, happy birthday to Mama McCory. We thank you guys for being here. I would sing, but I'm not ready. It's kind of early, so
We appreciate it.
Mom, you still on here? We're gonna sing.
You gonna sing?
Happy birthday to you. Happy birthday to you. Happy
you.
birthday, Mama McCrory. Happy birthday to you. May the good Lord bless you. May the good Lord bless you. May the good Lord bless you. Happy birthday to you. Woo!
All right, let's go. Right. I hadn't warmed up the vocal cord. That wasn't ready. All right, so we see you guys tomorrow. Stay safe, make good choices. 988. If you as a money love is having a mental health crisis, make sure you dial 988. Know that we love you. Jesus loves you better. Stay safe, make good choices, and we will see you in the AM. Peace out.